Hey guys, in this video I'll teach you how to recognize the most essential chart patterns that are used by market technicians to identify potential trade setups. Knowing this will not only improve your chances of finding profitable trade setups, but will also help you stay in the trade for longer. Here's the list of chart patterns that I will start covering in the upcoming lessons. Unlike I was doing before, I'm going to divide this topic into 10 separate videos to cover each pattern individually. I hope this will make it much easier to digest. So let's get started. The first category of chart patterns are the ones that usually go along with the trend. These are called the continuation patterns. They basically form during a phase in which a price of a security just rests for a certain period of time before continuing to move in the direction of the major trend. In this video, I'll cover one of the continuation patterns that's called bullish and bearish pennants. A sideways pattern that forms during an uptrend and which resembles a pennant is called a bullish pennant chart pattern. This pattern consists of three parts, which are the initial uptrend momentum, a brief sideways consolidation, and a continuation of the price move to the upside. The flagpole is immediately followed by the main body of the pattern, in which we can observe a formation of lower highs, along with higher lows that indicate that bulls are still in control, regardless of bears trying to push the price down. Lower highs also suggest profit taking, since we're not seeing higher highs anymore. But this is not a long-term situation because higher lows will eventually cause the pennant formation's upper channel to be breached and cause another surge in price. This can be fueled by newly created long positions and short sellers being stopped out at the same time. Keep in mind that bears need to buy to close their short positions. This combined with bulls opening new long positions only increases the pressure to the upside. The bullish pennant pattern gives traders an excellent opportunity to initiate long positions. This can be done the moment the price breaks the upper channel of the pennant and surges above the most recent lower high. The stop loss order can be placed under the higher low that immediately precedes the breakout point. The target is usually identified based on measuring the distance from the bottom of the triangle to the top. By doubling it to the upside, we can reveal the potential target point. Alternatively, the stop can be trailed until triggered at some point in the future. The bearish pennant, on the other hand, can be an opportunity to sell during a downtrend. The pennant part in this bearish pattern looks very similar to the bullish one. We still can observe lower highs along with higher lows, but this time the sellers are in control. The flagpole is inverted and the expectation is the price will break to the downside. So how do we engage in this situation? We can initiate short orders as soon as the price breaks the lower channel formed by higher lows. Ideally, it is even better if the shorts are initiated once the price takes out the most recent higher low on top of breaking the channel. This somewhat guarantees that the move is not a fake out and it doesn't immediately reverses on us. The stop should be placed right above the previous lower high that immediately precedes the break point and can be trailed as well. For those who are not fans of trailing methods, we can do the same measurement of the distance between the top and the bottom part of the triangle in order to discover the set target price point. Since bullish and bearish pennants are the continuation patterns, traders should always initiate positions that go with the trend and never against it. Let's take a look at the S&P futures chart and see if we can identify a pennant structure. As you can guess, there's a bullish pennant formation here. We have the flagpole and the main middle structure followed by the continuation to the upside. We can apply the entry method described earlier by placing the long trades at the actual breakout of the triangle's upper channel, or alternatively on the pullback once there's a second breach of the top of the triangle. This area also acts as a resistance zone. The potential target can be identified doing the measurements as shown on the slide. The bearish pennant, on the other hand, is an excellent opportunity to short for both breakout traders and for those who wait for confirmation and short on the retracements. As you can see in our case, the breakout area also serves as a resistance zone where short positions can be opened on the pullback. Keep in mind that the real charts will always have variations when it comes to entry areas. You just need to train your eyes to spot these zones and place trades based on the particular formation that's being analyzed. But in general, the patterns usually look similar on different charts, and once you learn how to identify them, it's very easy to spot entry points. As usual, the target can be set using the same method I explained earlier. I hope you guys learned now how to identify bullish and bearish pennants. Although it's going to be hard to read charts in the beginning, with more practice it's gonna get much easier. In the next video, I will cover bullish and bearish flag patterns. But until then, thank you guys for watching and I wish you green trading days.